Now, our first speaker today is Therese McGrath. Therese has been Pepper Money's Chief Financial Officer since 2018. Whoops. Don't mind me. She has extensive experience internationally across finance, strategy, and operations. Before joining Pepper Money, Therese held numerous senior roles at various companies, including Diageo plc, Thomson Reuters, Microsoft, SAP, and Australian and New Zealand banking, as well as various directorships in financial services. Now, we've all seen and heard of the endless headlines about market conditions and the economic forecasts. But what do they mean for your business? What do they mean for your clients? More than ever, your clients are seeking your support. With 70% of borrowers turning to brokers, Therese is here to help you go beyond the headlines. Now, you can submit any questions through the Q&A function throughout the presentation, and if we happen to have time at the end, I will ask them. But if not, we'll answer them post today. Please join me in welcoming Therese to the stage.
Are we there yet?
No.
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 Are we there yet?
You little...
I think we're there.
Good morning, everyone. My name is Therese McGrath. Don't know about the rest of you, but the last 12 months for me have felt like an endless road trip. I've got the noisy kids in the back, kicking the back of the seat, going, are we there yet? Are we there yet? It has been a long and a bit of a difficult journey for us all as we've tried to navigate our way through the current macroeconomic conditions that we're seeing. So about 12 months ago, let me just make sure I'm getting the slides up. There we go. About 12 months ago, our lovely treasurer, Anthony Moy, stood on the stage and sort of said, okay, looks like the cycle is going to be sharp, but it should be short. We should be coming out of the cycle roughly in 12 months' time. I'm not going to say that Anthony lied, but he didn't get it quite right. Globally, inflation has continued to rise. In Australia, we have seen fairly persistent inflation. This has been driven off the fact that we've seen our goods inflation come down, but services, Netflix, travel, entertainment continues to drive inflation forward. And so it has been a difficult path. What's happening in terms of interest rates? Because it has felt like 12 rate rises is a very, very blunt instrument to apply. But you have to remember that interest rates are being used to try and control the inflationary trends. Australia actually has a slight benefit versus the rest of the world in that the majority of our loans continue to be variable. In a number of countries offshore, the length of a mortgage is 10 years plus. So when the Reserve Banks use interest rates as a way to try and control and bring inflation back by diminishing customers' purchasing power, in a variable market, it can work. Now, this is one of the reasons why we've actually seen our inflation rate slightly below the rest of the world and taper, and importantly, why we've also seen our current interest rate not rise as sharply, because the variable rate curve has been able to actually temper some of the noise. And in this environment and what we've been going through, it's not surprising that consumers really are feeling the stress points. So just on this page, I'll sort of put a couple of little headlines in. Inflation continues to be persistent. Whilst goods inflation is coming back, we are still spending on services, and that's what's fueling inflation. I've got some team members here at the moment who are quickly looking at the RBA website because we're expecting the quarterly CPI to come out today, or it is coming out today, and all eyes are on it, because it's going to give us a good indication of what's going to happen next week in terms of potential interest rate rise. But what else is going on for consumers, for your customers? We're also seeing mortgage costs increase. So versus 12 months ago, mortgage costs, that's the amount of disposable income that's going to actually fund mortgage costs, has increased 7%. Alongside this, savings ratios have really come down. At the peak of COVID, people had 20% saving ratios. That was June 2020. It has come down to 3.7%, and that is actually below the long-term average of Australia. We normally run around the 5% mark. So people are eating into their savings and using it as a bit of a buffer for inflationary pressure and increased interest rates. Likewise, real wages are not keeping up with inflation. So what you tend to see is wages are rising at a lower rate. Inflation continues to be accelerated because of the service element. But it's not all doom and gloom, guys. There are some positive shoots, and the most important positive shoot, or the most important positive indicator, continues to be unemployment. 3.5% unemployment basically means anyone who wants a job can get a job. And if people have income coming in, they continue to be strong. So, with that noise going on for consumers, what does it actually mean for lenders? What we are seeing universally across the industry is that low funding costs that we experienced during COVID, like the low interest rates consumers had during COVID, have gone. And we've returned back to normal. We have returned back to the long-term average. So consumers saw, interest rates, or the OCR from the Reserve Bank of 10 basis points during COVID. We're now at 410 basis points. Funders have actually seen funding triple over the period and go back to the long-term average as well. So just as consumers are having pressure, lenders are having pressures as well. So one of the things I thought might be interesting, because I've sort of been asked, how do lenders make money? What is the profit curve for a lender? Thought it was a good idea maybe just to take a step back and run through the margin of a typical prime loan. So, okay, prime loan, 6.9% for the borrower rate. But what if lender has to do is then take out things like commissions? It has to take out cost of funds. And I've circled that cost of funds because that 5% range is the range that we will see going forward. It is returning to normal. And then on top of that, you've got to take your loan losses into account. And then you have to fund the business, your employees, your marketing, your technology, your operating costs. So based on a typical prime loan, the margin that a lender takes is about 0.9. It's important that we, as an industry, really understand the economics, because we actually have to have a healthy industry and share in the industry profit pool. One of the real things to remember as well when it comes to a prime loan, a lot of the cost, or a majority of the cost, are front-end loaded. That actually means that the lender takes a profit hit in the short term, and it takes time for the loan to actually get back to profitability. So on average, an indicative prime loan, 80% LVR, it's going to take roughly 13 months for the lender to see that loan get to break even. Then the loan needs to stay around in order for the loss over the first 13 months to be recouped and profit made. Now, one thing you all know that's been going on in the industry, the days of 6-year, the days of when people stayed with you with a loan for 6 years have long gone. What's the average length, the average life of a prime loan these days? 2.75 years, 3 years. So it's quite a quick race to be able to get to profitability and to get the returns, so the lender can keep on funding strong industry growth through technology, through distribution, through focusing on providing, the customer elements that you all want, quick, rapid turnaround, automated decisioning. So, understanding the profit curve that we all share in and how the industry is making money is incredibly important, because it's how we will all be healthy. And just as we are seeing these economics play out and a tightening of our profit margin across the board, likewise for borrowers, the road is going to still be bumpy. So, 12 months ago, we thought we'd be out of it. I think we've still got another 12 months to go. Borrowers are going to continue to see higher mortgage costs. You cannot assume that interest rates, OCR, will go back to anything like it was during COVID. Interest rates are going to tend back to the long-term average of 300 to 400 basis points. That is the new norm. That is the OCR. I shouldn't actually say it's the new norm. It is the old norm. Likewise, Australian households do continue globally to be amongst the most indebted. So from a balance sheet point of view, there's a lot of debt sitting there. Spare cash is actually dropping for most people. We saw that with with the savings ratio being down at 3.75%. And likewise, so many of your customers and you personally could be facing into what everyone's calling the mortgage cliff, that movement from fixed to variable rate. And then likewise, we all get a bit excited about rising house prices. It's a good thing because it gives people confidence, but it's also a little bit of a negative thing because rising house prices is coming about because the supply is so low. And as a result of that, we're seeing service inflation be pushed a little bit as well. So, do you think we're going to avoid the R word? And I don't mean Rahayim. I actually mean recession. Yeah, I think we will. I think there's some good shoots out there. Unemployment is key, guys. We continue to have such low unemployment and very high participation rates. That means people have money coming in the door. Very positive. Immigration is a positive as well. Having people come in stimulates demand and will stimulate growth. With our unemployment being so low at the moment, it's impacting productivity. Getting people back into the country and getting back to growth is a positive thing. We sort of said savings ratios are low, but the household balance sheet is very healthy. It is very good. People have equity in their homes. And importantly, China is reopening. That will see an influx of international students. International students contribute 1% to the GDP. Likewise, you see a stimulation of tourism, travel, and importantly as well, if China gets back, we should see our energy exports increase as well, good for terms of trade. There are some negatives though, or some bumps, which we just need to face into and watch out for. Productivity, productivity, productivity. We are at zero productivity in Australia. To be a developed nation, we need to get to that 1% mark, or a developing nation, we need to get to that 1% mark. What that basically means is that we need to do more with less. We need to invest in the right ways. We need to make sure we're applying technology, getting efficient and driving productivity. Productivity is the one big thing you're going to hear from the Reserve Bank that is holding the country back. So really think about your productivity. Household income as well, bit of a wobble coming up. We are asset rich, but we're a little bit cash poor, but we can balance that. And then likewise, inflation is going to continue. It's going to be a little bit of time before we're back into the target range that the RBA has set, but we can do it. The RBA is being a lot more pragmatic these days and they're giving themselves a slightly longer timeline. So hopefully we're going to see the end of that rapid interest rate cycle. What does it mean for you? How do you navigate the noise? Brokers have never been as important as they are today. Banks have walked away from the high street. They have closed their branches. You guys have all stepped in to actually fill that void. Getting a mortgage is a complex financial structure. People need that face-to-face support to help them navigate through, to help them cut through the noise. That is your role. One of the things you've got to ask yourself, though, are you keeping pace with the market? So the number of brokers have grown. You've never been more important. What's happened to your share? Are you growing that as well? So one way to do that is to think about your value tree. What are the levers that you all can apply to profitably grow your business? This value tree, I'm not joking, Mara and I use this on a weekly basis. This is a live model within our business. And what we do is we take all of the revenue streams and we go, what's driving that? What is the lever that will drive that revenue? Number of applications, prime versus non-conforming. Is it, BDMs on the street, the number of calls that they do? We break it all down and we understand the contribution from that driver and how much it can actually help drive both revenue. Importantly, you've got to do the same on the cost side. Sit back and say, okay, do I want to invest in technology to get a better yield per BDM, per relationship manager, or am I actually happy to build the number of people I have? Which is the best lever for me to apply and to drive? So you work your way through your P&L. You think about your key drivers and you think about how hard you can pull that to drive revenue or get costs out, to drive efficiency, productivity, and growth. And I'm serious. I have used this tool in the last 3,000 years of my working life. And I've worked across beer. Yes, I used to be the CFO of a beer company. Ask me why I've come into financial services, I don't know. But I've used it in beer, I've used it in technology, and I've used it here. If you don't take the time now to really understand what is driving revenue and costs into your business, you will miss the opportunity to grow and survive. I'd be really happy, whoever is the first to get up here with your financial accounts, to actually sit and do the profit drivers for you. Because if we could create a little model that you can all have in the back of your head, that you know which levers to pull and which ones to focus on, we will grow the industry profit pool. We will be healthy. So, look, guys, it's not just about today as well. I know sometimes it feels like we're just sort of coming into the office and getting more done, but you've got to think about tomorrow and the next day. So the other thing that we do as a business is we think around our horizons for growth. About today is really about efficiency. Can I, with my current customer base, do more? How do I become more efficient? The next horizon, the thing that you should be thinking about is, how do I actually become more productive? With my existing customer base, can I offer them more opportunities and more solutions? Or with new customers, can I sell what I know that I'm really good at? Can I find new customers to actually drive more mortgages into? So from efficiency and productivity, the next thing you cycle your head around is growth. And at least one day every week, guys, if you're not sitting back going, how can I think about the next horizon in growing this business? You're not going to be setting yourself up for future success. You need to start on the growth curve today if you want to grow. So literally every week within the business, aside from looking at our value trees and talking about our numbers and talking about the drivers, the other conversation we have is, what's Horizon 3? How are we going to be here and be relevant and growing in 3 years' time? And it's actually something that's very important to our investors as well. We actually always are thinking not just about today, but managing the business in the long term. It's why we've been in business for 23 years, and it's why we'll be in business for another 23 years, because it's not just about today, it's about tomorrow and the next. So I think Anthony sort of went through this with you last year. What you've got to think about cutting through the noise. Increasingly, your customers are coming under stress. Roy Morgan has literally just released today, a study about mortgage stress. They've called out that 29.7% of mortgage holders in Australia are facing stress. They've actually called out if there is another interest rate rise, they think that number will tip up very quickly to 35%. Encourage you to have a look. I think it's been published today in the AFR, but clearly your consumers, your customers are under stress. So, get on the front foot. If you know your client and you think they're in a good, strong position, they're managing well, just connect in. That relationship is so important. If you know your client and you think they could be coming into some wobbles, connect in and start the dialogue around how you can help them and how they can help themselves. Go through the budgeting, go through discretionary costs, find ways to actually help them carve their way back, get them on the right path and help them cut through the noise. You know your customer. If you think they're under stress, get proactive. Really get on top of it because there's options available. Do not let them put their head into the sand. Financial transactions are complex, they're stressful. Help manage them through it. It's why you as brokers are increasing in numbers and increasing in share, because you are so relevant to your customers. You are never going to be more relevant than when someone is facing stress. So, a couple of key takeaways. Again, I'm not going to say Anthony lied, but he certainly exaggerated. The cycle is longer than what any of us expected. Cost of living pressures are continuing to really put a challenge on inflation. The one thing I think is going to happen is we will not see a reversal in interest rates in Australia at least until the second half of next year. So, I suspect based on today's inflation headlines, we may see one more rate rise come through. I think the terminal rate for interest rates in Australia will be 4.35 to 4.6, so maybe one, maybe two interest rate rises coming. But if we can start to slow down that service level of inflation, we should be able to see interest rates stabilise and then slowly come down from next year. Very important, guys. We're never going to go back to the interest rates that we saw during COVID. So make sure you're preparing your customers for the long-term average interest rates. The OCR, the official cash rate, will probably be around that 3% mark. We should avoid a recession. It's going to be bumpy. So be ready for helping both yourselves and helping your customers through. It is about good planning, and it's about good support to your customers and being proactive. Likewise, really, really make sure you are staying on track. Take the time today. Understand what is driving revenue and costs into your business. Understand how you can be more efficient. How can you drive productivity? And focus on your Horizon 3. Focus on your growth. Think about efficiency, productivity, and growth. You will be here not just next year, but you'll be here for another 23 years as well. And most importantly, know your customers. Your customers trust you. It's why your share is growing. Take that trust and help them through this bumpy path, because they will value you and will value that relationship. So on that note, I've actually gone a little bit over. I'll take a step back, and you've heard enough from me. Why don't we hear a little bit now from our customers?
We just come out of a relationship, had to sell the home we owned. I really needed to get security for my children. It became easy because Pepper Money gave me a loan. Prior to that, it was banks just turning me away. Obviously, massive sense of achievement, a lot of gratitude. Gratitude to the world, gratitude for Pepper, and a sense of relief and, happy tears, so many happy tears.